They say the best time to fix your roof is when it's sunny outside. You don't want to be fixing it during a rainstorm. So, on today's Talking Sense, we're going to be breaking down everything you need to know about the next recession, what to do before the recession, and what to do during the recession. Today, I've got Teresa Arago with me from the Conway office, and she's going to help me break down what a recession is, where we are now, and how to get ready for a recession.
Can I just address one thing, though? Because you made a comment about the sunny day thing, right? And we are kind of in a sunny day right now. The market has been doing really well, despite, all the harbingers of death that are out there talking about how it's looming, the recession is looming. But it's been pretty good. But also, I think a lot of people have this skewed view of what a recession even is. So I know you're going to get into that. But I wanted to start by just saying it's not always dramatic. When we talk about a recession, it's not always this big dramatic. A lot of people go back to 2008, which many of our listeners probably were toddlers or weren't even around for. But, it's not where everything collapses necessarily. It doesn't have to be that way. So let's talk about what it is and what it's not.
Yeah, so a recession is 2 consecutive negative quarters of GDP. So typically in a recession, you're going to see the stock market has been red for a couple quarters, and it happens all the time. It's all cyclical. It's typically not some big event happened and that caused it and the world's going to go up in flames like most people think, but it is cyclical. After the market has gone up for a certain amount of time, it typically needs to correct itself a little bit. And it's completely normal. Most years in the market are green, but every once in a while you're going to have red years. So it's not the end of the world. When the market is going down, we're not freaking out because we know that that's normal. If you look historically at the S&P 500 or the NASDAQ, you'll see that there's been a lot of instances where it's down for 2 months, sometimes a year, sometimes 2 years if it's a depression or something a lot more severe. But just know that the market typically rebounds, and over a 15-year time span, it has rebounded every time it has gone back up.
Another thing I recently learned was that if you look at the history of recessions, they've shortened with each one. Now, obviously, we can't guarantee you they will be that way. We can't guarantee you we wouldn't walk into something crazy tomorrow. The market has risk. But, you look back over time, and there was the Great Depression, and then there have been recessions since where what I have found interesting is that if you look at the statistics, they shorten each time. The length of time that we stay inside of it between when it started and when it rebounds has gotten shorter, which is encouraging as an investor to think about. And financial risks are going to increase during that time. I mean, if you were a home builder in 2008, it was tough. It was a tough thing to go through. Jobs are more scarce, so you got to be careful about that. And certainly don't take it for granted. And if you're not financially prepared, it does have an impact when we enter a recessionary period. But I did want to start with just encouraging you that, just hunker down and let's talk about some things you can do to prepare here in a minute, but don't panic. Anytime you're dealing with your finances, if you're panicking, you're likely to make the wrong decision. So always pause and consider the risks of whatever decision you're making, whatever the environment looks like, before you make a decision that you may not be able to unwind.
Where are we now? Where's the economy now? Are we in a recession? Are we in a growth? Well, right now, it's actually been a really good year. 2024, the S&P 500 is up 25%. So the market looks great right now. Since 2020, it's been really high. If you go and look at the S&P 500 or NASDAQ and do 10 years, you'll see how much it's up, and it's up a lot. And we've had some down years. You had COVID where it went down and then it rebounded within 2020. So it's completely normal. I know a lot of people in 2020 were thinking it's the end of the world. We've got this pandemic. The market's down.
You couldn't even get toilet paper. I can appreciate that being a challenge.
can't get toilet paper, and it was a weird time. But we've rebounded. We're way higher than 2020, and consumer spending right now is strong. Economy strong. It's also been a crazy year because of the election, so it's been a lot more volatile. But after the election, the market was green, and we can't say it'll keep going that way, but it has been going up. And yeah, it's been a good year to say the least.
And I think some people will say, oh, market, because you'll hear the news outlets say, oh, the S&P hit an all-time high. It has hit a lot of all-time highs. So don't let that make you panic either. It just means that there has been growth, which is a good thing, especially with inflation where it is we need growth in our investments to be able to keep up with it. So yeah, the market has been very kind to us. I like to tell my clients I'm not taking credit for it because I don't want to take credit on the other end of it. We're just going to try to diversify. But we're certainly not in a recession now, and we haven't been in one in a while. And some people would argue, well, it's got to happen because we haven't had one in a while. But if the last 15 years has taught us anything, it's not got to happen. We can have small corrections without having to have a full-on recession and the market be healthy. But statistics would tell us at some point it's likely coming. So what can people do, though? Because it's just like my car. I get in my car, there's a chance that I'm going to wreck. It's just there. Whether it's me or someone else that causes it, there's a chance. So I have ways to protect myself from the full brunt of that risk, or in the event that it happens, by wearing my seatbelt, by having insurance. There's things you can do too. So let's talk through those.
Yeah, I think a first great step to take is just having an emergency fund. And that's before you have a recession. I think that's important, or even in the good times, because having an emergency fund, it's a really good peace of mind. And if things change, you have some big medical expense or normal house expense, car expense, or you lose your job, you've got an extra pile of cash. Typically in recessions, there's a lot of layoffs, so you're at the higher risk to lose your job. So if that's the case and you were to lose your job, if you have that emergency fund, you know that you can pay the bills for hopefully a few months or half a year while you're looking for another job.
And many of you would say, I listen to this show all the time. You guys are constantly harping on emergency savings. You're right. We are, because studies have shown us, USA Today did a survey. 27% of Americans have zero emergency savings. So that's a quarter of our population that has nothing in savings. And I'd say it's not uncommon among clients that we meet with for the first time for them to have very little or no savings. So yeah, we're going to keep harping on it because it's so important that if something happens, you don't have to go into debt, especially in a recessionary period, to take care of those needs. Another thing you can do is living within your means. I have found it very interesting that the people who retire millionaires are typically not people with high-paying jobs or what you would consider a high-paying job. It's usually people who had a consistent habit of living below their means and didn't carry a ton of debt, so they had margin to save. And when you're talking about preparing for a recession, or really just the storms of life, if we're just being more broad, making sure that you're living below your means to have savings, to have some space to take care of the things that might pop up is so critical to your financial independence in general, and certainly in a case of a storm of life.
Another really important thing to do is diversifying your investments. You got to consider your risk tolerance, especially if you are a retired individual, because if I'm taking income from a growth portfolio and then the market crashes and it goes down 30%, if I'm taking, we'll say, just for easy figures, $100,000 a year from that, and that's, we'll say, 5% of my portfolio. Well, if that portfolio goes down 30%, I'm either going to have to take less income and maintain the 5% withdrawal rate, or I'm going to have to take the same amount of income and be taking a way higher withdrawal rate. And that's when you get into that reverse dollar cost averaging, where you can really deplete your assets fast if you retire into a bad year. So having your investments diversified and, maybe having some cash for income if the market were to go down in your retirement, or having some alternative investments that don't move completely with the stock market, that can be a really good way to keep getting good income and not worry about depleting your assets.
Yeah, I think a lot of people try to mirror the S&P 500. I think that is a mistake in a lot of ways for people. I think at the point that we're recording this episode, 7 companies are the bulk of what constitutes the S&P 500. So if you're invested in an S&P 500 fund or ETF that tracks that, you're not well diversified. You're very tech heavy, and that could be a challenge, especially if there's a tech bubble of some sort that hits. It can help you grow, yes, but it can also expose you to more risk than you need. So having a strategy that balances risk with return could really benefit you, but also make sure that you just stay the course. If the market dips, especially if you're younger and you're still adding to it, then you have an opportunity to buy during that dip. So panicking and selling or trying to make wholesale changes to your portfolio may not be in your best interest during that time. So in preparation for that, build some education, understand your investments, understand your allocation, and understand your why, so that when the storms of life come, you're not panicking and making an emotional decision with that. The other thing to consider is keeping your credit score high. I'm not a huge proponent of stressing about your credit score. I will acknowledge that I've never been really concerned about that. But I will tell you that if you need debt, you want to be able to get that debt cheap. And also when banks, if we do go into a recessionary period, banks historically have gotten tighter on who they will give credit to. So if you have a score that is subpar, then you're going to have challenges with getting a new car if you needed it, or getting approved for a loan if you needed it. So making sure that you're paying attention to that. And it's not that difficult to keep your credit score up. It kind of boils down to just making your payments on time, paying attention to your what's called your debt to available credit ratio. So you have X number of dollars that you could use. How much of that are you using? What percentage of that? And then the other one is if you're worried about a recession, don't close old accounts. I have a card that I've had for, probably 15 years. I don't use it. I just keep the account open because I know that it will affect my credit score because I had some purchases I needed to make this year. So I've kept it open. But I'm also very careful to monitor it to make sure somebody doesn't fraudulently use it. So there are things you can do to just pay attention to that. And we've done some episodes on that before. So if you want to go check through our archives and look for those related to credit scores, you can certainly educate yourself more about it.
And finally, I think one other really good thing you can do to prepare for a recession, it's just mentally have a long-term plan, a long-term mindset about your retirement monies. And this is a little bit more tailored for accumulators, but when you hit a recession and the market is down, you don't want to sell all your stuff because it's not like you've lost the money. Your shares are worth less money. And usually after a recession, you typically see a lot of growth right afterwards, after it's dipped. There's a stat that I read recently that if you go out 10 years and you see that history shows us that the threat of negative return on a 10-year rolling basis is less than 6%. And for 15 years, history has indicated that there's never been a 15-year rolling period of negative returns on the S&P 500. So what that means is, in history, now not saying this won't happen, but historically, the market has not been down over a 15-year span. So when it does go down, it has always rebounded in 15 years. So if the market goes down, just hold on, bear through the storm. It's going to go back up eventually.
Mm-hmm. And again, we can't guarantee it, but I agree with you that there is history to teach us that we don't need to panic if we're thinking long term. We often will talk to clients about this, specifically when they're investing, when they're adding to their portfolios, about how, the market goes up, the market goes down. And if you're being consistent, you have a higher chance of catching some of those down market periods. So what you're doing then is you're getting those shares for a less expensive price, which means as those even get back up to where they were pre-recession, you have more shares. I had a client call me once during a recent downturn in 2022, and they said, "Oh my goodness, my portfolio is way down." I said, "Okay, did you lose shares? Did someone go in there and steal your shares?" No, your shares are just worth a little less right now. Stay the course. Remember your why, which is why having a plan is so important, and just trust the process. We're going to be okay. Stay with it. And they did, and they rebounded. So, again, we can't guarantee you that you're never going to lose. Obviously, the market has risk. It's always going to be there. It always has. But you can manage your behavior to ensure that you don't make that decision that could affect you long term by panicking and getting out.
Well, I think that brings us just about to the end of our podcast. What would your 2 cents be?
About 61% of adults say that investing in the stock market is scary. That it's intimidating to get into the market in the first place. If that's you, I would say take some time to educate yourself. But if you've got an employer plan, especially, just get started. Pick something. We talked about target date funds in an episode we just finished the other day. Go check it out. Get started and just stay the course. Get some education. You'll be just fine.
And if you want some help getting started, download the 6 Keys to Financial Independence. You can visit getreadyforthefuture.com/keys or text keys to 501-381-5228. Thank you for joining us again today on Talking Sense. We hope we gave you some good information that you can hopefully apply to your life. And if you want to find more content, you can find us on Facebook, YouTube, or anywhere that you get your podcast. Thanks for joining us on Talking Sense.
Thanks for listening to Talking Sense. And if you like what you hear, make sure and subscribe to the podcast to get all the newest episodes. The Jim Wealth team is available to you 24/7 at info@getreadyforthefuture.com or by calling our offices at 866-653-PLAN. That's 866-653-7526. And while we like to have fun here, we're also financial advisors, and that means disclosures. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and Jim Wealth Financial Advisors are separate entities from LPL Financial.